Oh boy, what a day it was yesterday. Good morning. I am Kenny Polcari, your host of the party, and today is Thursday, December 14th, 2023, and there is so much to talk about. So here are some of the things that you need to know, right? Oh my God, what happened yesterday? Well, apparently, JJ stuns the market and he changes the narrative. Can you imagine that? Higher for longer apparently is higher for shorter now after what we heard yesterday. Bonds surge, right? Sending yields plunging. The Dow makes a new all-time high and the S&P enters a new century. And what do we have for dinner tonight? Well, it's a side dish, right? It's the fried asparagus. Oh my God, so delicious. One of my favorites that my grandmother used to make. Okay, look, and the pivot officially began, right? Investors, traders, and analysts go all in on stocks and bonds. The headlines are on fire yesterday and this morning as the Fed makes it clear that higher for longer isn't really higher for longer. It's just now higher for shorter, as the dot plot now shows a strong bias to lower rates in 24 and into 25. JJ confirming that the rate hiking cycle is now over. And while he left the door open, he made it clear that he wasn't going to walk through it. Although he did say this: it's far too early to declare victory, and there are certainly risks. Right, risks that inflation may be fooling us and the possibility that lower rates will only re-stimulate it. But let's move on. Instead, he focused on the risk of causing unnecessary harm to the economy by leaving rates too high as inflation falls, saying that we were very focused on not making that mistake. Now, recall the mistake that they made when they held rates at zero for 9 months longer than they should have, when inflation was screaming higher. But let's not go there. That's water under the bridge by now. Essentially, yesterday, he confirmed that he'd rather cut a bit sooner and try to stay ahead of it versus chasing it lower if the economy starts to fail. But by all accounts, it certainly does not feel like the economy is about to fail at all. I mean, does it? Everywhere you look, everything is coming up roses, right? I mean, we're hearing that the shopping season is another blockbuster season. Online sales are up 9% year over year. Holiday shopping up 4% year over year. All while inflation falls and wages rise and unemployment remains at historic lows, we apparently have avoided a recession, even as the yield curve remains inverted now for 22 months, leaving investors to celebrate. I mean, how great is this? The papers put it all in context with the headlines. The Fed starts to pivot towards lowering rates in the Wall Street Journal. And the Fed prepares to shift to rate cuts in 2024 as price pressures fade on Bloomberg. And on Fox Business Network, the Dow closes above 37,000 for the first time ever as Powell hints at rate cuts. Some will say that news caught investors off guard. I'd say, really? I mean, stocks have rallied strongly over the past 6 weeks. Certainly no one got caught off guard, I don't think. Rising better than 15% across the board, right? Off that October low when the headlines were all suggesting tougher times ahead and sticky inflation, blah, blah, blah. Suddenly, the narrative has shifted from caution to celebration. And that sent the S&P into a new century, rising 64 points or 1.4% to end the day at 4707. Now up 23% in the year. The Dow piercing 37,000, end the day at 37,090, up 512 points or 1.4%, 12% in the year. The NASDAQ joining and gaining 200 points, up 41% in the year. The Russell, small and mid caps, jumped 67 points or a whopping 3.5%, now up 11% in the year. The transport's gaining 200 points or 1.3%, up 16% in the year. And the equal-weighted S&P gained 130 points or 2.1%, leaving it up 9.5% on year. It's amazing. And exactly why time in the market is the answer for the long-term investor. Now, sector performance. Guess who outperformer was? Hint, it wasn't technology. Come on, think about it. What sector is so rate sensitive that it got crushed when rates rose and should benefit now if rates fall, and projected to fall even more? It's boring. It's not sexy. Utilities! Bang! They exploded higher. The XLU rising 3.8% on the day, leaving the sector still negative on the year. creating an opportunity if the Fed is correct, right? Making it a sector to add money to going into the new year. Now, remember, investors buy utilities for their relatively boring story, but their hefty dividends, typically 4% or so. So when rates shot higher this year, utilities got crushed, falling nearly 20% as investors shifted out of utility stocks and into 5+% government money market funds, short duration treasuries, one-year CDs, etc. This way, they took equity risk off the table and guaranteed themselves 5% in riskless assets. So now when rates are projected to come down 3% as far as Goldman's concerned, then 4% utilities look great. And since so many of the stocks have gotten pummeled, there's upside in the stock price as well as upside in the yield. NEP is just one example. NextEra Energy Partners down 70% into early October, went from $70 to $20 in October as rates rose and the talk of higher and longer rates was the narrative, right? It has now risen by 40% over the past 6 weeks as that narrative started to change, going from 20 to 28, all while yielding 12%. Hello, anybody home? Now, yes, that yield is going to change as the price rises, but there's plenty of upside in the price. So get in and enjoy the ride. Every other sector in the 11 S&P sectors was higher. Real estate up 3.3%. Healthcare, another underperformer in 2023, gained 1.8%, leaving that sector flat on the year. Capiche? Consumer staples, XLP up 1.8%, and that sector is still down 3% on the year. Think opportunity. Energy, the XLE up 1.4%, and that's gotten beaten up over the last month. Industrials up 1.1%, think no recession. Financials, XLF up 1.6%, lower rates, more loans, maybe less defaults. Consumer discretionary, XLY up 1.3%, basic materials, XLB up 1.2%. Communications, XLC up 0.9%, with technology coming in last place, up 0.8%. Now, further down the line, you saw retail, XRT jump by 3.3%. Disruptive tech, Cathie Woods' ARC up 3.7%. The value trade, SPYV, jumping 1.5%. Semis up 1.5%. Cybersecurity up 1.1%. Aerospace and defense up 1.4%. Oil and gas exploration up 2.5%. Home builders up 2.5%. And if you made a leverage bet going into yesterday, then you hit the jackpot. The SPXL, which is the Direction 3 times levered S&P, rose by 4.1%. I mean, I could go on. It was a palooza, right? And bonds, oh my God, yields plunged as prices rose. The 2-year surge, right, causing yields to fall by 30 basis points to end the day yielding at 4.32. The 10-year falling 20 basis points to end the day at 4.01. Recall it was yielding 5% only 6 weeks ago. An amazing 20% decline. And if you went long the bond, then look at what the TLT has done. It was up 2.5% yesterday and has risen 18% since October. The TLH up 2.1% has risen 13.5% during that same period. And in the housing market, the 30-year money is now below 7%. The latest rate quoted at 6.8% for a conventional loan, 6.25% for a 5-1 arm, and 6.37% for a 10-1 arm. And that should ignite the real estate market once the spring selling season hits in February. Now, on to oil. It looks like it found some support at $70. And this morning, it's trading up $1.30 or 2%, right? It's like 70.5. News that OPEC's crude output fell by 100,000 barrels per day in November is helping today's move. Losses seen in Nigeria, Angola, and Iraq, right? It was operational issues in Angola, weather in Iraq. The Saudi volumes were up slightly, as was Kuwait and Iranian output as well, but not enough to offset the losses. In the end, you know the drill. It is still the non-OPEC producers that are flooding the market and causing agita for the kingdom. We remain well below all three trend lines as it looks to find support right in here at 70. On the chart, though, longer-term support appears to really be around 65, while resistance is at 76. So we're in that 65, 76 range. And gold, oh boy, I hope you didn't panic and sell it over the last couple of weeks because it jumped by $50 to end the day at 2,048 yesterday. And this morning it's up another $5 at 2,000, close to 2,043, and it's trading at 2,048 now. All this is JJ made it clear that inflation is over and that rates are going lower, and this will put pressure on the dollar. And guess what? It did. Yesterday, the dollar fell 1 full percentage point or 0.9%, going from 103.86 to 102.86, slicing right through the trend line at 103.5. And this morning, it's lower again, falling another 50 cents to trade at 102.36 at 7 o'clock. Now, all this because we were told that higher for longer is no longer the narrative. And the VIX, yep, that continues to fall, confirming all of the rumors that investors have nothing to worry about. Rates are going lower, the economy is doing just fine, it remains robust, and Goldilocks is, hello, knocking on the door. I mean, what could go wrong? What could go wrong, right? Economic data today, it's all about retail sales. They're expected to be down 0.1% month over month, while ex-autos and gas is expected to be up 0.2%. Tomorrow, you're going to get U.S. services and manufacturing PMIs. Manufacturing is supposed to in contraction zone, right, at 49.7, while services remains in the expansion zone at 50.5. But remember, the eco data will mean less and less as we move into the end of the year, as so many people prepare for the holidays and the New Year's celebration, and who's away from their desk and who's putting in, stop orders both above and below the market, right, or buy and sell orders above and below the market, in case there's a big move. U.S. futures are up again, even after yesterday's surge. At 7 o'clock, the Dow's up 86, the S&P's up 12, the Nasdaq up 55, and the Russell is ahead by 20. Goes right to my point about small and mid caps. Treasury prices are up this morning, and that's putting even more pressure on yields, and it's also putting pressure on the dollar, and that's helping stocks move higher. The 10-year is now broken 4% and is back yielding 3.96. The big investment banks now tripping over each other to try to pick where 10-year yields are going to be at the end of the year after yesterday's drama. And as I said, Goldie and Jeffrey Gundlach of Double Line fame are both calling for the 10-year to hit 3% in 2024. So now expects the analysts to call for S&P 500 to have an even higher year-end target in 2024 than what they had already projected. Those S&P 5,000 target calls are now certainly going to be 5,400. It's only a matter of days before we see them all line up. European markets are also celebrating on the back of the U.S. moves yesterday and the idea that the Bank of England left rates unchanged as well, suggesting that they too may have hit a peak, and that and the rates in UK maybe are set to fall as well. Now wait till we hear from Christine Lagarde at the ECB. Will she join in too, or will she remain more diligent? Now, like I said, the S&P closed at 4707, a new century, up 64 points, making yet another new closing high for 2023. We're now only 80 points away from the all-time high seen on January 4th, 2022. And now it's not if, but how long is it going to take the algos to push us there, right? The excitement is building. The 10-year is now below 4% and likely going lower. And if Europe begins to cut too, then watch global equities surge. But on the other side of the argument is that the Fed is cutting not because the economy is so robust, but because they see economic issues potentially ahead, rather than just a decline in inflation, never mind the coming election. Which is a bit curious as well, because the Fed should not, actually is not supposed to move rates 6 months before an election, just not to be seen as political. That apparently is not the case this presidential election cycle. They have hinted that rates could start as early as March, but more likely May, and then continue through the year end, which means right through the presidential election cycle into 2025. And that could smack of election interference. But hey, let's not go there right now either. In the end, all of this excitement favors and reinforces my argument for starting to save early with a tax-advantaged long-term retirement account, and having a plan to stay in versus trying to pick tops and bottoms. Now, while I think the market feels a bit overdone, and I do, right, it just doesn't want to stop yet. But that doesn't mean that you should just chase it. There are opportunities. You just need to look for them, right? Think that NEP opportunity that we just spoke about, right? We have priced in again. We have priced in perfection. We're assuming that the S&P earnings are going to grow at 12% estimates. We are assuming that inflation is under control. And we are assuming that the Fed is going to cut rates by 75 basis points, although Goldie and Gundlach assume 200 basis points. And we are assuming that the Fed has navigated a soft landing and that we have avoided a recession. And we are assuming that the unemployment rate does not explode higher. And while I hope it all comes true, I'm remaining committed to the plan. Remember, trees do not grow to the sky. The market will not continue to advance just because it has advanced. Growth becomes maturity, maturity turns into decline, and the life cycle and the business cycle go through peak to trough and trough to peak. It's just what it is. It's like the life cycle, right? You're born and then you die. And then somebody's reborn and then they die. It's the cycle of life. In any event, review your plan. Talk to your advisor. And remember, investing is not trading, it's investing. Focus on the long term and not the daily machinations of the markets. If you're a long-term investor, don't be emotional. Do your homework. Take advantage of the dislocations in the names that you own or want to own. Do not chase. And if you're just starting out, don't be dismayed. There's plenty of opportunity and time is on your side. Call me to discuss. 212-381-6194. I'm always happy to have a conversation. Okay, so now, we've gotten through the Feast of the Seven Fishes. Now you got to have some sides and some veggies and all that. And on every holiday, my grandmother used to make these fried asparagus spears. They are just delicious. It was one of her signature holiday dishes. But, I mean, she made them all year long, but especially around the holidays, right? You can make these a day ahead, just to help you avoid the pressure of the day, right? Preparation, like investing, is key. Now, for this, you need fresh asparagus spears. You need Italian seasoned breadcrumbs. You need flour, eggs, and olive oil. You want to begin by trimming off the white part of the asparagus, right? So bring it right down to where the green is. Place these, fill a frying pan full of water and then place the asparagus spears laid out in the water and blanch them just for about 5 minutes or so, right? Don't allow them to get limp. They should be firm to the bite, but not raw, right? Once you blanch them, take them out and immediately put them in a cold water bath to stop the cooking. Now, remove and pat them dry with a paper towel and get them all nice and ready. Now, next you're gonna have the flour on a plate. You're gonna beat 4 or 5 eggs in a large bowl where you can put the asparagus in. And then you're going to have your Italian seasoned breadcrumbs on another plate, right? You set up the assembly line, the flour, the egg wash, and then the breadcrumbs, right? So dredge the asparagus in the flour first, then dip them in the egg wash, and then roll the asparagus in the breadcrumbs, right? Set them aside, repeat that process until you're done. Now, in a large frying pan, you're going to heat up enough olive oil so that you cover the bottom of the pan. Let it get nice and hot because they have to sizzle the minute you put them in. Right? So get it nice and hot. When it's ready, start to place the asparagus spears. Then you'll hear it sizzle. And it browns the breadcrumbs right onto the asparagus spear. You want to turn them over just so that you brown them. After a while, turn them over so that they're browned on all sides. Take them out. Put them on a plate right now, just with paper towels. That'll drain some of the oil that's still maybe left in the spear. And then when you're ready to serve them, place them on a nice platter. Like a nice white platter works well with this because the asparagus has got some green on it. The breadcrumbs are kind of goldeny brown, and so it all looks pretty like that. Anyway, so put the breadcrumbs on this plate. Put the plate on the buffet table if that's how you're doing it, because that's how we do it. Because we serve the Feast of the Seven Fishes. And so it's not a sit down serve dinner. It's more kind of enjoy what you want dinner. And so here's where we're going to put the asparagus spears tomorrow. I'm going to give you the simple broccoli. It's a simple broccoli that's always a Christmas classic, at least in my house. Until tomorrow, look, it's kind of another cloudy day out here in Florida. We've had kind of this cloudy week. I am going out to get my Christmas tree tomorrow night. Funny that I do still buy one here in Florida. Feels a little bit odd, or it used to feel a bit odd. Now it kind of feels normal again. But we're going to get that tomorrow. In any event, until tomorrow, take good care.